Hello and welcome to NDTV Profit. A very good morning to all the viewers. I'm here, Altadia. And one stock that is in focus today is Happiest Minds Technologies and on the back of earnings. To discuss more, joining us on the show is Mr. Venkatraman Narayanan, MD and CFO, as well as Joseph Anantharaju, co-chairman and CEO. Welcome to the show, gentlemen, and a pleasure to speak to you as always. Overall, if we see in terms of where earnings are concerned, a revenue growth of around 2.5%, a slight bit of a dip coming in terms of the EBIT margins, and the profits are down 32%. Do understand that there is a PAT and EBIT that has been impacted by a one-off this time around. If you could help us understand what is that exceptional item and bad debt, which is remeasured the fair value of the contingent consideration, and there is a change of around 23 crores and a bad debt of around 12 crores during the quarter. If you could help us understand what is it with regards to.
Yeah. Good morning. So what I'll do is I'll just cover the highlights of the financials. Like you rightly pointed out, we have shown very good revenue growth, be it in rupees or in constant currency, very much 1.1% for the quarter, year over year 28%, and for the full year to full year about 26%. As far as EBITDA is concerned, we are at about 19.3% this quarter compared to 21.1% in the previous quarter. There is a drop. This drop is primarily on account of the bad debt provision that you referred to. That was about 12.5 crores and a one-off event. You adjust for that, we are pretty much at a similar number as the previous quarter of 21.1%. For the year, we are showed a EBITDA of 21.4% versus 24.6%. If you adjust for the bad debt, we are at about 22%. And just to refresh your memory, our guidance for EBITDA for the year was 20 to 22%, and we are very much in line with that, with and without the bad debt provision that we talked about. As far as this bad debt is concerned, it was one of our larger customers. It was a win that we had in Q3. It was smartly ramping up, but they had a substantial part of their forecasted business was to come from the US government, as we understand. And that, for some reason, did not happen. And it could be because of the change in dispensation or whatever. And so they had to they reneged on their payment obligation, which meant we had to stop work. We stopped work. We stopped work in Q4. It was ramping up very nicely. A run rate of about $1 million, $1.5 million is what we were at for that customer. But notwithstanding that, we have still shown a revenue growth, which is what I want to highlight. So we lost a run rate of about $1.5 million. We covered it up with business growth and showed a revenue growth. Coming below that to PAT, as I had said in the past, we have noise from accounting for earnout and the non-cash charges which come from acquisitions. Typically, to see the health of a company, you should remove the noise, the accounting noise that comes from all of these items, which is what we have attempted to do through this number called adjusted PAT. So if you look at adjusted PAT, we are at about 9.9% compared to 10.7% in the previous quarter. The simple explanation is the bad debt and slightly higher tax provisions that we have made this quarter. Year over year, we have got 11.4% of adjusted PAT versus 14.9%. The difference, as I've said in all my previous calls, are because of the investments that we have made. We have made close to 40 crores of investments in the new unit of GBS and the new sales. That and the bad debt, if you reverse most of it, we are back to about 13%, which is very similar in terms of the profit profile that we showed in FY24. FY24, we did not have interest costs because we had not done the acquisitions. This year, we have got interest costs coming on account of acquisition, which obviously will have
one quick clarification I want is the bad debt of around 12 crores this quarter that has been recognized. Is it fully recognized, or is there any further recognition that has to happen in FY26 as well?
Nothing. We have completely taken a hit on account of the bad debt. We started business in Q3. Whatever we built in Q3, we had to take a bad debt. We have done that. And we also have immediately stopped business in Q4. So, all the actions to be taken as taken.
Okay. With that, Margins, absolutely, in terms of what you had guided for. A miss that has happened in terms of your FY25 constant currency revenue growth, 35 to 40% is what was anticipated. You've come in lower on that front. What is the outlook looking like in terms of FY26, taking into consideration all the headwinds that we are seeing in the US markets, and US to an extent is a large part or majority part in terms of your business?
So I'll cover the part on forecast that we had given. We hadn't given a revenue guidance because we had acquired two companies early part of the year. So we were just trying to consolidate and give you numbers. We said 28 to 30% in constant currency. You're absolutely right, and we have come to it about 26%. So we are 2% shy of the forecast that we had given. Because and the reason for that is it took us we lost about 40 days in consolidation of our acquired companies. One was that. The second is the sudden drop in revenues from this one customer who had ramped up nicely in Q3. These and various other geopolitical aspects hit us by that 2 to 3% that we thought we would do over the Q2 and Q3 of the year, which didn't happen. As far as the markets and the outlook are concerned, I would pass it over to Joseph for his comments.
In our recent press conference, we had given a guidance that for this year we would do double-digit growth, and we are still holding on to that. The pipeline that we have gives us the confidence. We have several large deals. And as far as US is concerned, from a market perspective, I think things, as you would have read, I think one of the huge uncertainties was the tariffs with China, between China and US. That seems to be settling down, and I think that will give a lot of the manufacturers and other verticals that have their presence in China much more clarity, because the uncertainty was what was holding people back. So I expect that to ease up, and several of the other country-to-country deals should get done. Our expectation is that by end of Q1 or Q2, we should see things settling down. As far as customers are concerned, I think by and large, we have not seen any customers pull back. They may have paused some of their investments or slowed it down, but we've not seen any pullback. And as far as our pipeline and our projections go, we are quite confident about the double-digit growth that we projected.
Okay, so with that, if you have to talk about PureSoft as well as the other acquisitions that have been made, I think there was a delay in terms of finalization, and hence the revenue accretion has gone lower in the fourth quarter. Assuming all of them now will be 100% in terms of FY26, what's the quantum that you're expecting in terms of contribution from the 3 to 4 acquisitions that have been made?
We don't give a breakup of that in our financials because it's consolidated now. We have been working together over the last 11 months, and things have almost kind of integrated. Aureus is integrated, Pure Software is almost integrated, and the couple of customer acquisitions that we did in the Middle East, all of them are nicely integrated. So now it's a one company forward for FY26, and the growth numbers that Joseph talked about is on that basis.